Traders, George here, and I'll leave you with another good reference point here from this morning's session. We talked about trends versus strong trends, and here's a breakdown, and I'll show you some good strategy numbers here as well. But here's an easy way to think about it. Think about markets either contracting or expanding. Okay, when we have contraction, we can see a tradable range, or we can see a range that's so compressed that we have stagnation. So there is sort of a good and a bad side to contraction. For expansion, it's the same deal. There's a good and a less good aspect to expansion. In a contracted market, if everything plays nice, we're going to see sell signals and buy signals at the tops and at the bottoms. And the DSR levels are going to show us where they are, with end of move signals firing off in those areas, and it'll be a magical, perfect trading environment. Unfortunately, that's not always the case. When we have range expansion and price moves away from the contraction, our same signals will hold true. We can still see a buy signal that could lead to a bounce and a scalper being hit, and we could see an outside return and then a continuation down for a sell signal. But at some point, we're going to start to see buy signals fire off that get steamrolled by the dominant trend, and there will not be enough energy to the bounces to show us a sell signal to go along for that bigger ride, yet the buy signals will still fire off and we'll get steamrolled there. So this can turn into some losing price action. This type of change from where we're getting buy signals and sell signals that are working in a trending environment to where we get signals more weighted to the losing side that are getting stopped out, and we're missing signals in the dominant trend, that happens when we really get into some heavy duty range expansion. And we went specifically into gold and oil, and I showed you how to find those areas and what to look for. Review your notes on that to stay on top of that in the future. But this is the visual change of what happens. So some of you asking the same questions this morning, this is the phenomenon that drives that behavior. Now here's a cool way that you can stay on top of it. I'm using the fib stop and reverse strategy here. This is one of my favorite ones, and right now I have this thing just set up to do scalpers, so it's not looking for any momentum runs, no dynamic exits. It's just give me a signal, give me an exit, here's my stop, end of story. This has done pretty well here just over the last 3 weeks or so. It's $1,640 on only 29 trades, but look at it's a 51% win rate there. So obviously losers getting stopped out for less than the winners are booking, right? And therefore there's the positive expectancy. You can see here that it's actually losing money on the long side, and this is for gold. So for the most part, gold has been selling off for the last 3 weeks, and this is why the long side is not in the black. And the sell side here has got some really good gains. Actually put up 2640, able to capture 1940 of those gains based on the system here. This is still playing nice within the realm of directional movement. We know we've moved from contraction to expansion in gold, and we're still in this phase right here. In fact, gold's had a pretty good bounce, so the likelihood of this happening in gold is very low now that we've bounced. But I'm on alert for this happening. I showed you guys where to see that price action happening. We're not there for gold. We know we were there for oil, but we were ready for that. This is what drives that phenomenon. So whether you're trading the DSR model on its own as a level 1, whether you're at the next level doing semi-auto work with either the cluster trader or the fib stop and reverse model, or maybe you're watching this video for the first time and you've got your own system you're working on, or whatever it might be, this is universal right here. So contraction, expansion, usable contraction, non-usable contraction. So usable contraction is a range that still gives us nice opportunity. Stagnation is when this zone is too narrow from floor to ceiling and it's been stuck there for a period of time. Expansion, we sure like that, but at one point we need to watch out, especially to the downside, if we're running over our long signals and not getting the short signals to get that extra gain. What you do not want to do is form fit your strategy to this part of the equation, which doesn't come up that much, but it comes up enough to put up some losses if you don't know what you're doing. And unfortunately, the tendency for certain traders is that they will look at this as sort of the problem that needs to be fixed, and they'll make an adjustment so somehow this turns into a profitable signal generation here. The problem is that leaves this in the cold and this in the cold. So this is not the normal price action here. This is the one that we want to guard against and make provisions for when we move to it, and be aware that we're ready to move to it. You need to know what to look for, otherwise it'll catch you off guard, and by the time you pick up on it and you make a change, it'll be too late and we'll be getting back to this. Happens all the time, right? So just think about these graphics right here. If you're using the Auto Trader, it's a snap to go through an analysis like this and check out that your scalpers are working fine. If your scalpers are working fine, you know you can put your trader on and at least be getting to break even, if not picking up more gains on these. This is just the scalper firing off one contract here over about 3 weeks, and gold doing real well. And we know with the nice bounce we've had in gold that we're not likely to see this happen in the near future for gold. All right, gang, that'll do it on this aspect of strategy analysis. We'll see you back in the live room.